Today we're going to tackle a question that every investor faces at some point. Is a great company ever too big or just too expensive to keep on growing? We're going to use one of India's biggest banks, HDFC Bank, as our case study to see what we can find out. Okay, let's get right into it.
So let's wind the clock back to October 2019. HDFC Bank is an absolute titan, a real market darling. But behind the scenes, a pretty intense debate was starting to bubble up among some really smart investors. The big question was, had this star performer finally hit a wall? Was it just too pricey to even think about buying?
And here it is, the heart of the problem, laid out perfectly on the Value Picker Investment Forum. An investor points out that the bank stock price is 30 times its profits, that's the PE ratio, and its market value is 4.5 times its net assets. Look, you don't need to be a Wall Street analyst to know. Those are some seriously premium numbers. And the question on everyone's mind was, could the bank possibly live up to that kind of hype?
And this right here is the classic investor's dilemma, isn't it? What do you do? Do you stick with a proven winner, even when the price tag looks kind of scary, or do you get out fearing that the music is about to stop?
Okay, so first, let's put on our skeptic's hat. Let's really dig into the arguments for being cautious. What were the specific red flags that were making investors so nervous back in 2019?
All right, so for the bears, it really came down to these 4 big worries. First, that sky-high valuation we just talked about. Second, this thing called the base effect. The bank was already huge. Growing at 20% year after year meant adding a massive amount of new business, and that just gets tougher and tougher the bigger you are. Third, the whole Indian economy was slowing down, and a lower GDP, well, that usually means more people might struggle to pay back their loans. And finally, some folks saw the bank's aggressive new marketing tactics, big loan fairs and iPhone giveaways, as maybe, just maybe, a sign of desperation.
And all of this really boils down to one fundamental question. It's like a law of physics in business. As companies get bigger, it gets harder to grow fast. It's the law of large numbers. And the skeptics were betting that HDFC Bank was about to learn that lesson the hard way.
But of course, that's only one side of the story. For every bear, there's a bull. And the bulls, well, they looked at the exact same set of facts and came to a completely different conclusion.
Now check this out. This slide just perfectly captures the debate. The bears saw this giant company that had run out of room. But the bulls? They looked at it and said, wait a minute. They only have an 8.58% share of all the bank loans in India. To them, the opportunity was still absolutely massive. The runway for growth was still incredibly long.
And this is the core of the bull argument. It's a bit counterintuitive, but they believed that a tough economy wasn't a threat. It was actually an opportunity. You see, when things get hard, the weaker competitors start to stumble, and that leaves the field wide open for the strongest player to come in and just scoop up more market share.
And here's another forum member, Atesh, who just nails it. Other banks and lenders were having problems, which meant less competition for HDFC Bank. From this point of view, a crisis wasn't a headwind, it was a tailwind. It was actually fuel for faster growth.
To back up this long-term view, the bulls brought out this classic definition from Warren Buffett. They didn't just see HDFC Bank as a lender. No, they saw it as a compounding machine. A business that could take its profits and just keep reinvesting them at these really high rates of return, creating this powerful, wealth-creating snowball effect over time.
But where was all this compounding power coming from? Well, one investor argued that most people were missing the bank's secret weapon. Everyone thought it was a bank, but it was really a fee-generating machine that just happened to also have a bank attached. And this is where the magic happened. It was so much more than just loans. This bank was woven into the very fabric of the Indian economy. It was managing cash for huge corporations, collecting a massive chunk of the country's taxes, clearing trades on the stock market, selling insurance, you name it. All of these things generate steady, high-profit fees, and a lot of it with very, very little risk. So there you have it, 2 totally compelling but completely opposite arguments back in 2019. You've got the bears saying it's a pricey giant that's peaked, and you've got the bulls saying it's a compounding machine that's just warming up. The debate was fierce.
It's the ultimate question in investing, right? If only we could just hop in a time machine and see who was right. Well, for this explainer, that's exactly what we're going to do. So let's do it. Let's jump forward 6 years to October 2025. We're going to look at the bank's actual earnings report from that quarter to settle this debate once and for all. Let's see what the numbers have to say.
All right, it's time for the moment of truth. Let's take those fears from 2019, put them to the test one by one, and deliver the long-term verdict based on cold, hard facts from the future.
First up, that big, scary law of large numbers. Remember the worry? After 6 more years of getting even bigger, did that famous 20% growth finally just grind to a halt? Well, the answer is kind of fascinating. It's a yes and a no. That explosive 20% growth rate did slow down, just like the law of large numbers predicted. But, and this is a huge but, the bank still grew its loans by nearly 10%. For a company of this scale, that is still an absolute beast of a growth engine. Okay, on to the second big fear, the idea that a rocky economy would automatically lead to a ton of bad loans, or what the banks call non-performing assets. How did that play out?
And the verdict here is wow. It's so revealing. After all those years of economic ups and downs, the bank's bad loans were at a stunningly low and stable 1.24%. I mean, that just speaks volumes about their discipline, and it proved the bulls right. The really high-quality players know how to navigate the tough times.
So that brings us to the ultimate question, the big one. Did HDFC Bank actually live up to that lofty, Buffett-style vision of being a true compounding machine for its shareholders?
And this chart tells the entire story. The one number you really want to watch for a bank, its book value per share, which is basically its real intrinsic worth, just kept marching steadily upward. By growing that number year after year, the bank was, without a doubt, compounding value for its investors. The bull thesis was absolutely correct.
So what's the big takeaway here? It seems like sometimes, if you only focus on the valuation, you can miss the bigger picture. The real story is often in those hidden strengths, the deep moats, the fee-generating engines, the strong culture that lets a great company keep on compounding long after the skeptics have written it off. And it really makes you wonder, doesn't it? What giants out there today are we all underestimating?